Is it any wonder you can knock the price of silver down? There's nobody trades there.
There's nobody there. So I'm sitting here today looking at $4,000 gold, $57.50 silver on the close this afternoon.
Even this time I'm thinking, no, there's no way they can knock it down that far. That's impossible. The impossible happened. Do I know whether, the CME is going to come out and say, well, nobody's can buy silver anymore? And the CME would actually like that if they said it. We want to get them out of the silver market. They're not in the silver market. They're in the paper market. The price of silver rallies a lot here. It goes back to 120. They're going to be losing a lot of money on their silver position. Silver traded a 15-to-1 ratio to gold. When gold was at 4,500, silver should have been 300. Maybe more people go into the physical silver market, but you don't see that on COMEX. Although we do see it on COMEX, like in gold in particular. Almost every day, somebody's taken $1 billion worth of gold out of COMEX. Every day this month, including, I think, on Tuesday, another $1 billion of gold for delivery in the spot month. The next month, the July month, it's getting bigger in open interest too. So I think we'll be right back to that dollar weakness, gold strength, silver strength. The fundamentals will support the silver story. And there's hardly a day goes by when you don't read something going on in the electronics kind of business that isn't so powerfully great for silver, whether it's the solid state engines, the AI plants are putting up, and it just goes on and on and on. And I think we underestimate what really could happen. And one of the things I do fall back on is the knowledge that when silver and gold were currencies, silver traded a 15-to-1 ratio to gold. When gold was at 4,500, silver should have been 300, but it's been suppressed for all these 50 odd years by banks who've been short the whole time. I mean, it's shocking to think that we had that. As you know, I don't have a love on for banks. and I maybe I could get mad at myself for playing in a game where it's manipulated.
Right.
Wall Street is slowly embracing gold while still treating silver like an afterthought. And that contradiction deserves attention. Eric Sprott notes that industrial demand, monetary history, and institutional recommendations increasingly point in the same direction if multiple long-term drivers converge. Today's pricing may reflect sentiment more than scarcity. Investors ignoring that disconnect could discover the repricing only after momentum becomes obvious. Next, Eric Sprott exposes why historical gold-to-silver relationships challenge today's accepted market narrative.
You probably feel a little bit stupid because of it, right? And even this time I'm thinking, no, there's no way they can knock it down that far. That's impossible. The impossible happened in 30 hours. 30 hours.
Yeah, and as we record this late in the day here on Wednesday, June 24th, we're right down to what would seem to be pretty key support levels, that a lot of us been kind of targeting ever since all this nastiness began. So we're going to talk a little bit about what should drive prices back higher. Sure. Reminder, though, for everybody, Sprott Money, named after that guy right there, is a great bullion dealer. They will sell you physical metal and store it for you as well. They are the sponsors of all these podcasts, so be sure to visit sprottmoney.com when you're done watching and add to your stack. Eric, I wanted to start here because it's all about perspective, right? We've been doing this. We used to do this weekly way back in the day, but we do it now about every 6 months. I like to check in and see what you're thinking.
We're getting a little older, Craig.
Speak for yourself. No, anyway. Yeah, no, you're right.
I am speaking for myself.
Let me lay this on you. Because again, it's all about perspective. The last time we spoke back in December, gold that closed that day, 43.33 and silver closed 65.50. If we dial it back to last June, the previous time we spoke, 1 year ago, a little more over a year ago, June the 12th.
Some of the sharpest reversals begin immediately after investors decide recovery is impossible. According to Eric Sprott, violent declines can occur even when the long-term investment case remains intact. The difference between price action and underlying fundamentals often separates institutional accumulation from retail capitulation. Protecting wealth sometimes requires patience precisely when confidence disappears. Next, Eric Sprott reveals why perspective across years matters far more than panic across days.
Gold was 33.87 Silver was 36, 35.
Yeah.
So I'm sitting here today looking at $4,000 gold and $57.50 silver on the close this afternoon.
Yeah.
Yeah, what's changed? I mean, what has changed?
Yeah. After giving up a lot, and your best returns are when something's gone down and hit bottom and everyone realizes we did the wrong thing. And I want to talk about everyone maybe sometime realizing we all did the wrong thing, because one of the things that has hindered the stock market, the precious metal market, is the stock market.
Yeah.
Because it's been a wonderful place for people, particularly speculators, leveraged speculators, to make outsized returns very, very, very quickly, particularly if they were focusing on certain things. But when you look at the economy and the status of the United States government, the fiscal situation, the weakness in home sales, the weakness in commercial real estate, the weakness in private credit. You can't even get your money out of a private credit.
Right.
Private equity fund. You can't get your money out. I mean, they've starting to seal the doors here. That's how bad it is. So, and the whole bond market has been no panacea for everybody. So the only thing that was working is the stock market. And it was a very focused group of stocks that were working. For the most, first of all, it was the Mag 7. Then we moved into AI.
The strongest performing asset often hides the weakest underlying financial system. What Eric Sprott is highlighting is that concentrated equity gains can distract investors from deteriorating credit, housing, and fiscal conditions. When liquidity tightens, leadership can change much faster than the public narratives admit. Savers relying on yesterday's winners may discover diversification mattered only after capital becomes trapped. Next, Eric Sprott exposes why today's market leadership may prove surprisingly fragile.
Do I know whether, the CME is going to come out and say, well, nobody's can buy silver anymore? And the CME, I actually like that if it said it. We want to get them out of the silver market. They're not in the silver market. They're in the paper market.
Yeah.
We'd like them not to be there. Okay. So it's hard to predict that. And, you've still got that situation where the banks, the price of silver rallies a lot here, goes back to 120. They're going to be losing a lot of money on their silver position. So you can't be confident of when it's going to, you can't be confident of when it can, but you can be confident it should turn, which I am.
Yeah. Have you been selling any? There are some people, like even Rick Rule was out. Yes, I sold some silver at 110.
I had some levered positions, so I've had to stay in front of the margin clerk.
Yeah.
And I've had no trouble doing it, but I'm not going to sit there and keep buying all these new issues,
Yeah.
making my financial situation more precarious.
Okay.
And by the way, I wouldn't be surprised. We should be seeing some of these senior mining companies doing something.
Right.
In terms of takeovers, right? These things are dirt cheap. Where are you, boys? Come on.
Right.
Sitting there with all the cash and they are buying their stocks back, which I guess is good.
If banks are trapped on the wrong side of silver, the biggest risk may be assuming markets still trade freely. As Eric Sprott points out here, heavily short institutions cannot welcome a sustained price surge without damaging their own positions. That helps explain why paper volatility can look disconnected from physical fundamentals. Investors focused only on daily prices may miss the larger accumulation story unfolding beneath the surface. Next, Eric Sprott exposes why takeover activity could contradict today's pessimistic mining valuations.
I should talk about the IPOs. One thing that Eric knows from his living through these markets, huge IPO issuance is very bad for stock markets. Because let's take the 85 billion that our friends at SpaceX got.
Mm-hmm.
They're not going to buy stocks with it. So they get 85 billion from people playing the market, which they take out of their accounts or sell this to buy that. So they have to sell something.
Yeah.
And he's not putting the money back in the stock market. It's not going back in the stock market. All those AI guys that are raising money through bond issues and stock offers, which Google's doing 80 billion. And Anthropic's talking about an issue, and Chat GPT or OpenAI, I guess it is talking about a stock. These are big issues. This is money that comes out of the stock market.
Yeah.
It's liquidity that leaves the stock market.
Yeah.
And it's a bad omen for stocks. It is. And we're going through it right now.
Like the .com stuff you were talking about. These IPOs were coming out and sucking up all the cash 25 years ago.
That's what happened. Everyone is doing an issue because their stock's up here. And all of a sudden there's no money left.
Yeah. Hey, Eric, before I forget, I want to ask you one more thing. 'Cause you were talking about the CME and the banker playground and everything else that they do there. Are they running out of suckers in that the open interest, total contract open interest for both gold and silver is at multi-decade lows and has been for months? What do you make of that?
Massive capital raises often appear near peaks, not because optimism is justified, but because liquidity is easiest to harvest. According to Eric Sprott, enormous IPOs and equity offerings quietly drain cash that would otherwise support existing markets. History shows these issuance waves frequently precede weaker returns, as enthusiasm exhausts itself. Savers chasing headlines instead of liquidity trends usually recognize the shift only after valuations reset. Next, Eric Sprott reveals why collapsing COMEX participation sends a far different signal than mainstream commentators admit. Daily physical...
Yeah. No, I mean, is it any wonder you can knock the price of silver down? There's nobody trades there.
There's nobody there. Yes, you get huge volatility.
Yeah. No, maybe more people go into the physical silver market, but you don't see that on COMEX. Although we do see it on COMEX, like in gold in particular, almost every day, somebody's taken $1 billion worth of gold out of COMEX every day this month, including, I think, on Tuesday. Another $1 billion of gold is for delivery in the spot month. And the next month, August, the July month, it's getting bigger in open interest too.
Yeah.
And they never get off this stuff. You watch the change in rotation from the front month, which is a delivery month, to the outer month. There's almost contract for contract just rolls into the next month. They never get off the short. They can't get off the short. Well, they can't get off the short if there's no players too. So.
But I mean, like back in January, I remember 6 years ago when we were still doing the things weekly and you were like, hey, watch the EFPs every day. And then you got me watching that. Geez, I think like 17 or 18 when that started to spike. And by the time we got to January 2020, they were doing 25 and 30,000 EFPs a day, and open interest was 800,000 contracts. And now here we are 6 years later, they're doing a couple hundred EFPs a day, and open interest is 350.
Yeah.
I mean,
no, the interest there, I guess.
Physical deliveries can reveal far more than headline price moves ever will. What Eric Sprott is highlighting is the widening gap between shrinking paper participation and persistent physical demand leaving COMEX vaults. That divergence suggests institutions may be prioritizing ownership over speculation, while retail remains distracted by volatility. Investors protecting wealth should watch inventory flows instead of short-term price swings. Next, Eric Sprott exposes why one overlooked trading firm may benefit whenever silver suddenly collapses.
Well, you know what? I actually had some SLB calls for a while, and they did wonderfully for me. But I actually sold them before it took the big run. And I thought, you know what? I don't think SLB's got the silver. I don't know that I want calls on something that may not make it. And I still have that view. By the way, I meant to add one thing. The whistleblower out of the UK, Andrew.
Yeah. Mm-hmm. Andrew Maguire.
Yeah. He keeps dropping references to Jane Street.
Yeah.
You know what Jane Street is? This is a guy who plays the ETF against the stocks.
Yeah.
Well, I was thinking this myself. You know what? If I was Jane Street, if I knock the price of silver down in the COMEX, I get 200 different securities are going to go down that I'm going to arrange to have go down.
Yeah.
Big time. By taking this one down myself.
Mm-hmm.
and they're going to make a fortune on all the other 200,
Mm-hmm.
whether it's the PSLV, SLV, all the silver stocks, all the
Mhm.
gold stocks, all the various ETFs, the levered things, and like it's very worrisome to me that this can go on and does go on. And we know what goes on in the sense that I think they made $39 billion last year in the stock market,
Right.
and they
Yeah.
do something like 25% of all the ETF trades. It's just shocking.
Mm-hmm.
The market's biggest advantage may not be better forecast, but better market structure. Eric Sprott's argument suggests that firms operating across ETFs, futures, and mining shares could profit from volatility far beyond a single silver contract. Whether or not every suspicion proves correct, concentrated trading power deserves far more scrutiny than television headlines provide. Long-term investors should question who benefits whenever panic suddenly appears. Next, Eric Sprott unravels why extraordinary trading profits deserve far more attention than daily price charts.
But I worry about that in something as small as the silver market. Like, some guy went out and sold $1 billion worth of not SFB, but futures on silver. Everything goes down.
Mm-hmm.
And if you're short 10 billion and you use $1 billion to knock it down and cover the 10 billion short, and you lose a little on the $1 billion that you sold on silver, but I think it's a pretty good trade. So that worries me that might happen, or does happen.
It does have it. And I mean, would they make Jane Street profit in the fourth quarter alone last year was like $19 billion or something trading profit. And remember then they had that noted, or reported massive position in the SLV that then disappeared. And so there's a lot to that. I wonder though, if they've bled the stone as much as they can, Eric, maybe they'll come back in on the long side again.
They might have pushed it up, took the run.
Yeah.
Push it down, take the run.
Yep.
There's a lot of leverage there. And the fact that somebody that most people haven't even heard of could make that kind of money just by picking off the market,
Yeah. Is the answer just what we've always talked about?
They're not doing anybody any favors, okay? They're not doing the general public any favors.
For sure. End empire kind of stuff. Everyone's just looking out for themselves, like the politicians and the bankers and everybody else. But Eric, is it the answer what we've always talked about? Just, you know what? If someone's going to, Sprott Money's going to sell you an ounce of silver for $55, take them up on it.
We're going to be very close. Let
me,
and there's lots of people recommending precious metal. They aren't just precious metal freaks, including the guy at Morgan Stanley who said you should have 20% of your bond money in gold.
Right. Jeff Curry, who was always the analyst at Goldman Sachs, the head commodity guy at Goldman Sachs, said about a month ago he thought gold was going to go to 4,000 before it went to 10,000. So all right. Hey,
I wish I had said that.
When market depth is thin, even modest selling can create outsized damage for unprepared investors. This is where Eric Sprott's thesis shifts from price forecasting toward understanding how leverage amplifies institutional influence. Wealth preservation means recognizing that temporary dislocations can favor patient buyers instead of emotional sellers. The greatest portfolio mistake is assuming volatility always reflects fundamental value. Next, Eric Sprott reveals why owning physical metal may bypass risks hidden inside leveraged paper markets.
Eric, let me kind of take some time and just pick your brain a little bit about the stocks. I know a lot of people watch and just kind of like to get a feel for what your current thoughts are on the sector. What companies, if there's any ones you're adding to or you're excited about, that sort of thing. So I am just kind of leave it there. That's the question. Where do you stand?
I think my first move when I decide that I want to get introduce more funds into the precious metal markets, it will be some derivation of silver stocks. Okay, I think silver stocks will do by far the best. And I don't mean a particular company, but I mean like the SILV, maybe the amplified silver ETF, something like that.
Mm-hmm.
I think they'll run real fast. here. And I really own everything that I've ever had for the longest time. And I'm rarely a seller. Most of the things I own that are significant, I have big percentages that I have to report the sales all the time. So
Yeah.
I don't think there's any, I mean, I probably sold some USA silver somewhere along the line because it went into some index. I use that opportunity when something goes into an index. Sometimes you get some liquidity that you otherwise wouldn't have, particularly for someone like me who owns a lot of positions that are big, that, my own influence in the market would not be positive if I was a seller. So I tend just to, I'm a believer in a long-term hold. In fact, I saw that Charlie Munger said, it wasn't how careful how you bought. It wasn't.
Retail often searches for the perfect stock, while institutions focus on owning the right trend. Eric Sprott's argument suggests broad silver exposure may outperform endless attempts to identify a single winner. That approach emphasizes patience, liquidity, and long-term positioning instead of constant trading decisions. Investors frequently underestimate how much wealth comes from simply staying invested through uncomfortable periods. Next, Eric Sprott unravels why patience may be the most undervalued investment strategy.
Sorry, important how you buy. It wasn't important how you sold. It's important how patient you are.
Yeah.
That's the biggest thing. Just be patient. Let it work for you.
Last we spoke, you were, and I've seen you since mention quite a few times companies like Highcroft being something that you're still excited about. I don't want to actually get you to talk about anything specific.
No, I like Highcroft. It's my biggest position.
Okay.
They had a new MRE. They had 2.6 billion ounces of silver equivalent. 2.6 billion.
That's a lot.
That's more than almost everybody, I would point out. Okay. They've had some wonderful drilling to find high grade. They have a new high grade silver deposit. They're still drilling out. I think one of the reasons, other than the price of silver, that it's gone down recently, we haven't had any drilling news for a couple of months.
Yeah.
And you need that.
Yeah.
They came out with a PEA that said at spot prices at the time that the net asset value is $10 billion. Well, today it trades at $2.5 billion. So that's 300% upside. And that presumes the ore body doesn't get bigger, that they don't find better ways of processing the ore, which I think they're looking at extensively. And I think they're going to have something interesting to tell us about that. So no, I like it. I still own every share I ever bought. So fingers crossed.
Yeah.
And another one stock that I own that I probably should talk about again is Free Gold Ventures. They got over 30 million ounces of gold now. It just gets bigger all the time. The grade keeps going up. It's in Alaska. It's 25 kilometers from Fairbanks. It's 5 kilometers from Kinross's Fort Knox. I mean, it's going to be a mine someday. And yes, I think we've all usually suffered by the lack of interest in these things. There's just a general lack of interest.
Yeah.
The market rarely rewards patience immediately, but it often rewards it disproportionately over time. This is where Eric Sprott's thesis shifts toward asset quality rather than daily price movements, emphasizing resource growth and valuation gaps. Investors who focus only on quarterly performance can overlook years of compounding geological value. Long-term wealth is usually built before broad market enthusiasm returns.